everyone. My name is Karan Saigal, and today we would cover IFRS 15, Revenue from Contract with Customers. In the following presentation, we would cover the key concept and understanding of the new revenue standard. Now, the implementation of the new revenue standard is very important as it would be replacing the existing guidance and would change how companies account for revenue. Now, this training will help you to understand the five-step model used for revenue recognition and many other key concepts covered under the new standard. The agenda of this session is to cover the background of IFRS 15, the overview, scope, and the timeline of the new standard, the transition approach available with the entities, and the overview of the five-step revenue model. Let's understand why there was a need for a new revenue standard. Revenue is the most important element in any financials. Everyone would analyze the top line to comment on any company's performance. When we look at the current revenue guidance, there are separate set of guidance under the US GAAP and IFRS. This makes the companies preparing the guidance under US GAAP and IFRS incomparable. There are different policies for companies in different industries. Even the disclosures under the current standard were not adequate and not providing sufficient information to the users of the financials. FASB and ISB recognized that the current guidance needed improvement. The two organizations came together to develop a converged set of accounting standard. Now, this new standard is relevant across all the industries. The new standard replaces the existing guidance under the US GAAP and IFRS. It removes inconsistencies and provides more robust framework for addressing revenue issues. There are enhanced disclosure requirements which are both qualitative and quantitative in nature, and these set of new disclosures provide more useful information to the users of the financials. The new IFRS standard focuses on the five-step model to recognize revenue. This needs to be applied by the entity to ensure relevant and useful information is provided to the users of financial statements about the nature, timing, and uncertainty of revenue and cash flow arising from a contract with customer. The core principle is that entities should recognize revenue representing the transfer of promised goods or services to the customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange of goods or services. The new standard should be applied consistently to contracts with similar characteristics and in similar circumstances. IFRS 15 is applicable for entities reported in accordance with the International Financial Reporting Standard for periods beginning on or after 1st January 2018. The following areas are excluded from the ambit of the standard: lease contracts, which is covered under IFRS 16, insurance contracts covered under IFRS 17, financial instruments and other contractual rights or obligations covered under IFRS 9, non-monetary exchange between entities in the same line of business to facilitate sale to customers or potential customers. Entities can transition to the new standard either through full retrospective approach or modified retrospective approach. Let's discuss the first approach, which is full retrospective approach. Under this approach, entity needs to apply the standard retrospectively to all comparative period presented. So all the prior year comparatives are restated with one-time adjustment to the opening balance of equity in the earliest comparative periods. There are few things which needs to be kept in mind if the entity decides to use this approach to transition to the new standard. As the prior period financials would be recasted, this would be very helpful for the investors or the users of financials as it would provide comparatives. However, significant time and effort would be required to implement through this approach. This transition method would also be useful for entities which are expected to have material impact on adoption of the new standard, as it provides comparatives to the users. Under the second approach, modified retrospective, the entities needs to apply the standard only from the date of initial application. Under this approach, the entity needs to adjust the opening balance of equity at the date of initial application, but they are not required to adjust prior period comparatives. One of the disclosure requirements under this approach is to provide to the users of financials with the amount by which each financial statement line item is impacted in the year of adoption and an explanation of significant changes under the current revenue standard and the new standard. The good part about this transition approach is that there is no need to adjust the financials of prior years. However, the challenging part would be that the entity needs to close two set of books of accounts under each reporting period. I'll repeat, under this approach, there would be no information available on the comparative periods. Now let's talk about the five-step model introduced by the new standard. The first step is to identify the contract with the end customer. Important thing to remember is that as per IFRS 15, the contract needs to be enforceable in order to be a valid contract, irrespective of the form of the contract. This step also explains when multiple contracts needs to be combined and the term or duration of a contract. Now, once the contract has been identified, the next step is to list down all the performance obligation in the contract. The entity needs to identify all the goods and services promised in the contract and assess whether it's a performance obligation as per the new standard. Step 3 is to determine the transaction price. A transaction price is the amount of consideration an entity is expecting in exchange of transferring promised goods or services in the contract. Now, one needs to remember that there is a difference between the transaction price and the contract value. The transaction price can be different from the contract value depending on the terms and conditions in the contract and also certain historical trend and practices. Other factors which impacts the transaction price are variable consideration, significant financing component, non-cash consideration, and consideration payable to the customers. Now, once the transaction price is determined, the next step is to allocate the transaction price to the identified performance obligation in the contract. Now, this would be a very important step for a multiple element contract where there are multiple performance obligation and the entity needs to assess how to allocate the transaction price to each of the performance obligation. Once the transaction price is allocated to the performance obligation, the next step would be to recognize revenue as and when the entity satisfies the performance obligation. Now, this can happen at a point in time or over the time. Well, that's all we had for session 1, where we covered the background of IFRS 15, details around the transition approach, timeline, and the overview of the five-step model. In the next session, we would cover the step 1, which is how to identify a contract with a customer. Stay tuned for the next session. Thank you.